Have you ever wondered how the world of finance as we know it today came to be? It's a fascinating tale that dates back to the ancient world, but the real game changer occurred in the 12th century with a fairly simple innovation: bonds. Picture this: Italian city-states in the throes of the Renaissance, burgeoning with commerce and culture. Yet they faced a common problem: funding public projects. The solution? Bonds. A promise to repay borrowed money with interest at a future date. This innovation was revolutionary. It allowed city-states to raise capital, fueling their growth and prosperity. It was the birth of modern finance. Bonds became the cornerstone of financial systems, paving the way for more complex financial instruments. They offered a structured way of borrowing and lending, making finance more accessible and systematic. So the birth of finance as we know it today started with the introduction of bonds, a concept that has stood the test of time. But the evolution of finance didn't stop there. It took a significant turn in the 17th century. This was when the financial world first caught a glimpse of what we now know as derivatives. The concept emerged in Japan, with the establishment of the Dojima rice exchange. This was not just a market where people bought and sold rice, it was where the first known futures contracts, a form of derivative, were traded. So, what exactly are derivatives? In its simplest form, a derivative is a financial contract that derives its value from an underlying asset. This asset can be anything from commodities like gold or oil, to financial instruments like bonds or currencies. The purpose of derivatives is to allow investors to speculate on future price movements of the underlying asset, or to hedge against potential price changes. Back in the 17th century Japan, rice was a fundamental part of the economy. The Dojima rice exchange created a way for rice merchants to manage the risk of price fluctuations. They could enter into a futures contract, agreeing to buy or sell a certain amount of rice at a predetermined price on a future date. This meant that they could lock in a price today, protecting themselves from any drastic changes in the rice market down the line. This idea of risk management, which is at the heart of derivatives, has shaped the way financial markets operate today. Derivatives provide market stability by allowing investors to hedge their bets. If an investor is worried about a potential drop in the price of a stock they own, they can use a derivative to protect against this risk. Over the centuries, the use of derivatives has expanded beyond commodities to include a wide range of financial instruments. From interest rate swaps to credit default swaps, derivatives have become a vital tool for financial institutions around the world. They have brought about the ability to manage risk more effectively, opening the door to more complex and sophisticated financial mechanisms. The invention of derivatives was a game changer, allowing for more complex and sophisticated financial mechanisms. Fast forward to the 20th century, another significant financial invention emerged: the credit card. Let's journey back to the 1950s, an era filled with rock and roll, drive-in movies, and the birth of a financial innovation that would change the world: the credit card. It all started with a man named Frank McNamara, who famously forgot to bring his cash to a business dinner. This gave him an idea, and in 1950 the Diners Club card was born. Initially it was a charge card, meaning you had to pay off your bill in full at the end of each month. But it was the beginning of something much larger. The Diners Club card sparked an industry that would grow exponentially over the next several decades. By the mid-1950s, more companies started to dabble in the credit card business. In 1958, American Express launched its own credit card, and Bank of America introduced the Bank AmeriCard, which would eventually become Visa. The real game changer came in the late 1950s when the concept of revolving credit was introduced. This allowed cardholders to carry over a balance from month to month, paying interest on the outstanding amount. It was a revolutionary idea that fundamentally changed the way people spent money. Credit cards had a profound impact on the economy. They boosted consumer spending by providing a convenient and accessible line of credit. This increased demand for goods and services, fueling economic growth. At the same time, they also introduced a new level of personal debt, as individuals could now buy now and pay later. Moreover, credit cards transformed the financial industry. They introduced a new revenue stream for banks through interest and fees. They also spurred technological innovations, such as electronic payment processing and fraud detection systems. Today, credit cards are an integral part of our lives, with billions of transactions processed each year. They've changed the way we shop, travel, and manage our finances. They've enabled the rise of online commerce and the decline of cash. The advent of credit cards revolutionized consumer spending and played a pivotal role in shaping the modern economy. So what do these financial innovations, bonds, derivatives, and credit cards, mean for our world? The impact of these financial tools is profound and far-reaching. Bonds, for instance, have served as a cornerstone of public and private finance for centuries. They've funded wars, built infrastructure, and provided countless governments and corporations with the capital needed to grow and thrive. On the other hand, derivatives, often considered the most complex of financial instruments, have enabled investors to manage risk and speculate on future price movements. They've added a level of sophistication to our financial markets and have played a vital role in maintaining economic stability. Lastly, the advent of credit cards revolutionized personal finance, making it possible for consumers to make purchases and build credit, thus stimulating economic growth. Without a doubt, these financial innovations have transformed the landscape of global finance and continue to do so. It's fascinating to see how finance has evolved over centuries, isn't it? We've journeyed from the birth of finance, witnessing the transformative power of bonds, derivatives, and credit cards. Bonds, those debt instruments that governments and corporations use to raise capital, have been instrumental in shaping global economies. Then we delved into the world of derivatives. These financial contracts, derived from underlying assets, have allowed for sophisticated risk management and investment strategies, revolutionizing finance as we know it. And let's not forget credit cards. From their advent, these small pieces of plastic have transformed our relationship with money, providing convenience and creating a global consumer culture. These innovations have undeniably changed the world, shaping economies, influencing societies, and altering the way we interact with money. Indeed, the world of finance is a testament to human ingenuity and the relentless pursuit of progress. Who knows what the next big financial innovation will be?